Well, I'm here today to talk about the Reserve Bank's decision to raise the cash rate by 50 basis points to 0.85%. As you know, we've been arguing strongly that they should have done a major, what I would call a jumbo move, ever since we saw that first move on the 2nd of May. And I have to say that we're the only one of the major banks who has been consistently making that argument. And the reason why we made the argument was that we believed that the so-called emergency rate cuts that we saw in 2020 were no longer appropriate. Inflation was well above the target. The economy had recovered from the COVID shock, and emergency rate levels were no longer necessary. You needed to raise rates by 40 basis points to totally eliminate those emergency moves, but we argued that 50 basis points was possible as well. Of course, we saw that 50 basis point yesterday, and the question now is how much further will the Reserve Bank move rates? I guess the most important aspect of the statement yesterday was that they pointed out that over the month they've actually had to raise their inflation forecast further. And they also pointed out that while overseas factors have been very important in this very high inflation environment, it's also been due to domestic factors, a tight labour market and supply chain shocks within Australia and very tight capacity. So that means that the Reserve Bank absolutely has a role to deal with the domestic part of the inflation that they can deal with higher interest rates. It's also really important, as we've argued, that they need to contain inflationary expectations. They need economic agents to believe that the Reserve Bank is on the job, is targeting inflation to try and bring down those inflationary expectations. Because in a note that I released last Friday, we pointed out that the expectations of trade unions have jumped in the last 3 months. A year ago, their price expectations were 1.5%. They're now 4.3%, having jumped from 3.2% 3 months ago. And they're the sorts of things that the RBA needs to worry about. So what does the profile look like going forward? Well, we expect that the next move will be 50 basis points again in July. And think about where that would push the cash rate to 1.35%. Remember in 2019, after holding the cash rate at 1.5% for a very long time and seeing inflation sink well below their target, the Reserve Bank finally decided to do more cuts. So they cut rates by 75 basis points in 2019 from 1.5% to 0.75%. Those 75 basis points are also need to be reversed. And that's what I think will happen if we see a 50 in July and then another 25 in August. And indeed that 25 in August would also be in response to another jumbo inflation report that we'll see in late July. After that, the cash rate will have reached 1.6%. And that's what I would call in that sort of neutral territory. That's where it gets a bit more dangerous to have big rate hikes, because you can be pushing the economy too hard once you're over that neutral range. So I think what will happen then is that they'll have a little pause for maybe September and October, and then after the next, as we expect, next big inflation report in late October, they'll have to start tightening again by 25 in November and 25 in December. Next, that would get the cash rate up to 2.1% by the end of the year, and I would see the final hike as 2.25% in February, getting that rate up to 2.35%. That's only slightly more than we were forecasting before. And you might say, well, why is it only slightly more? Because you have raised your inflation numbers, and we agree that that is the case. But that's a testament to the advantages of going hard early. If you go hard early, I think you can get away with not having to go too hard at the end of the cycle when it can be so much more damaging. Once policy is in the contractionary range, which we think is above that 1.75, 1.65% range, once that happens, rate hikes become a lot more damaging. So in terms of growth, we believe that growth this year will be around 4%. We've lowered it from 4.5% that we had before, but that will be driven by a strong consumer, particularly in the June quarter and the September quarters. Now, I understand the consumer sentiment is going to get hit by these rate hikes, and we'll see that next week. But I think at the moment, the reopening effect, the fact that the savings rate is so high, and that's releasing a lot of spending. So in the first quarter of this year, spending was up by 8.5 billion. 6 billion of that was a result of the savings rate coming down from 13.6% to 11.6%, releasing more cash. So I think we'll see that reopening effect in the June quarter and to a lesser extent the September quarter. But then those rate hikes are going to really start to bite. And things will slow down substantially in the December quarter. And next year we're only expecting growth of around 2%. That's of course if we can see the inflation trajectory coming down next year, which we are expecting, and is certainly the Reserve Bank's expectation. But of course, if we're wrong on that and the inflation pressures continue to build, then of course the whole scenario will have to change. That's not our central view at this stage. Our central view is very slow growth next year, but slowing inflation, allowing the Reserve Bank to peak their rates at 2.35% rather than the 3.7, 3.8% that the market is currently expecting. Thank you.